Hey there, investors. Ever wondered how some REITs manage to stay resilient even when interest rates are squeezing the life out of distributions? Today, I'm diving into Frasers Logistics and Commercial Trust's latest results, and what I found might surprise you. While many REITs are struggling across the board, FLCT shows us a tale of two segments, one thriving and one barely keeping its head above water. I'll break down exactly what's happening, why it matters for your portfolio, and how you can position yourself to benefit from these market dynamics. Want to dive even deeper and get exclusive investing insights delivered to you every single day? For just $1 a month, you can become a premium member and unlock a wealth of additional content, including daily REIT analysis, early alerts on promising dividend stocks, and deeper dives into specific investment strategies that will give you a real edge in growing your wealth. Think of it as your daily dose of financial fuel. More on how to join after the intro. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 850,000 reads and 53,000 likes. I've produced over 800 videos with more than 350,000 watch hours as of February 2025. I also focus on regional and global economic trends. Let's jump right into FLCT's latest half-year results for FY 2025, which were released just yesterday on May 7th. The numbers tell an interesting story that every income investor needs to understand. First, the headline figures. Revenue increased by 7.5% year on year to $232.3 million, which sounds great on the surface. Adjusted net property income also rose, but by a smaller 1.6% to $161.3 million. But here's where things get interesting. Distributable income fell by 13.5% to $113.0 million, resulting in a distribution per unit, DPU, of 3.RA Singapore cents, down 13.8% from last year. Now you might be thinking, Iggy, why would I invest in something with falling distributions? That's exactly the right question to ask. But before we jump to conclusions, let's look under the hood to understand what's really happening here. The revenue growth came from several new properties joining the portfolio. Think of it like adding new income streams to your investment portfolio. These include full contributions from Ellesmere Port in the UK, 4 German logistics properties, a new property in the Netherlands, and one in Singapore at Tuas South Link 1. But this growth was offset by 3 main factors. First, higher vacancies in their commercial properties, especially Alexandra Technopark and 357 Collins Street. Second, higher non-recoverable land taxes in Australia. And third, lower average exchange rates for the Australian dollar and euro against the Singapore dollar. The main culprits dragging down distributable income were higher finance costs. Think of this as the mortgage payment going up on your investment property, and higher tax expenses. This is a common theme across REITs in today's higher interest rate environment. Now let's talk about FLCT's portfolio. Imagine you have 114 properties spread across 5 developed markets, worth about $6.8 billion. That's what FLCT owns. But here's the key insight. 106 of these properties are logistics and industrial assets, making up 72.4% of the portfolio value. Only 8 properties are commercial, accounting for 27.6%. This split is crucial to understanding FLCT's performance. The logistics segment has a near-perfect occupancy rate of 99.6%. That's like having a rental property that's almost never vacant. Meanwhile, the commercial portfolio is struggling with an 84.1% occupancy rate. Think of it as having 1 property out of 6 sitting empty at any given time. The performance gap between these two segments is widening. For the last quarter, the logistics portfolio achieved positive rental reversions of plus 8.7% on an incoming versus outgoing basis, and an impressive plus 33.0% on an average rent basis. What does this mean in simple terms? When tenants renew their leases, they're paying significantly more than before. It's like being able to raise the rent on your investment property by 1/3. Why is the logistics segment performing so well? European logistics vacancy rates are hovering around just 5%, Premium warehouses and city fringe locations are scarce. Logistics rents grew by 5.7% year-on-year as of last September, and rental growth is expected to outpace inflation this year. Meanwhile, the commercial segment faces more challenges. Singapore's office market showed some signs of life in Q1 2025, with core CBD Grade A office rents rising 0.8% quarter-on-quarter to $12.05 per square foot per month. But island-wide office vacancy surged to 11.7%, up from 10.6% in Q4 2024, as new projects flooded the market with 1.2 million square meters of supply. Let's talk about how FLCT manages its money. They've maintained a conservative capital structure with an aggregate leverage of 36.1%. Think of this as having a 36.1% loan-to-value ratio on your property investments. Pretty conservative by most standards. Their interest coverage ratio is 4.5x, meaning the income they generate is 4.5 times their interest payments. This gives them a comfortable buffer if interest rates rise further. About 69.7% of their borrowings are at fixed rates, which helps shield them from interest rate volatility. One interesting aspect is that 72% of their financing is green or sustainability linked. This focus on ESG factors might not impact short-term returns, but it positions them well for the future as investors increasingly prioritize sustainable investments. What about the broader market outlook? The Singapore REIT market has been under pressure due to higher interest rates, but there are signs of stabilization. S-REITs rebounded 5.9% since mid-April, with retail buyers offsetting institutional outflows. According to market analysts, S-REIT's DPU may rise later this year as interest costs peak. This potential recovery would be welcome news for income-focused investors who have weathered declining distributions. For the logistics sector specifically, the outlook remains positive. After a post-pandemic slowdown, logistics occupier market activity is stabilizing, with occupancy rates across the top 30 European markets close to 95%. New supply is projected to decrease further, dropping below 5% of total stock this year. Investor sentiment in logistics remains high, with logistics investment representing 23% of total real estate investment in 24. Prime logistics yields have been slower to fall than in core offices and residential, but this trend is expected to accelerate as the year progresses. Now let's look at FLCT's stock performance. The stock has been trading in a range between $0.81 and $0.93 over the past 3 months. As of today, May 8th, the stock price is $0.90. The stock is moving within a horizontal trend, with some technical indicators suggesting potential volatility ahead. There's a buy signal from the 3-month MACD, but sell signals from both short and long-term moving averages. Resistance levels are at $0.89, $0.90, and $0.92, with support at $0.88. So, what does all this mean for you as an investor? FLCT currently offers an annualized distribution yield of 6.5% based on its latest DPU. This yield is attractive in the current market environment, especially considering the trust's strong logistics portfolio and conservative capital structure. Let's break down the key strengths and challenges. First, the strengths. With 72.4% of its portfolio in logistics assets, FLCT is well positioned to benefit from the continued strength in this sector. The near-perfect 99.6% occupancy rate in the logistics portfolio demonstrates the quality and desirability of these assets. The strong rental reversions indicate significant embedded rental growth potential. Their conservative leverage gives them room to take on additional debt for growth opportunities if needed. And their ESG focus puts them ahead of many peers. Now for the challenges. The 84.1% occupancy in the commercial segment is a drag on overall performance. Despite having most of their debt at fixed rates, higher interest costs are still impacting distributable income. And with assets across 5 countries, currency fluctuations can affect returns for Singapore-based investors. If you're considering FLCT for your portfolio, here are some practical steps to take. Keep an eye on central bank policies, as any easing in interest rates could benefit FLCT's distributable income. Watch for improvements in the commercial portfolio, especially at Alexandra Technopark and 357 Collins Street. Look for acquisition announcements in the logistics segment, as management has indicated a focus on growing this part of the business. Continue monitoring vacancy rates and rental growth in FLCT's key markets. And given the current trading range, consider a staged entry rather than investing all at once. To sum up, FLCT represents an interesting opportunity in the Singapore REIT market. Its heavy exposure to the resilient logistics sector provides a solid foundation, while its conservative financial management offers some protection against interest rate volatility. The current DPU yield of 6.5% is attractive, especially considering the potential for recovery as interest rates stabilize. However, be prepared for continued challenges in the commercial segment and possible short-term volatility due to macroeconomic factors. As FLCT CEO Anthea Lee stated, they're taking deliberate steps to preserve debt headroom for long-term growth and value creation, while remaining mindful of the concerns associated with significant DPU fluctuations. If you found this analysis helpful, please hit that like button and subscribe to the channel for more insights on REITs and other income investments. Drop a comment below with your thoughts on FLCT or other REITs you'd like me to analyze. So, if you found this video helpful and want to level up your investing game with daily premium insights for just $1 a month, click the link in the description below to become a member. You won't regret having that consistent stream of valuable information that can help you on your financial journey. For more REIT analysis, check out my previous video on Mapletree Industrial Trust, where I break down another interesting opportunity in the Singapore REIT market.